Retirement isn't a puzzle, it's a minefield. Every financial decision you make is a chance to lose what you spent a lifetime building. From picking the wrong investments to draining your income too quickly to paying more in tax than you need to. Mistakes are everywhere. I'm going to walk you through the four biggest investment mistakes that retirees make so that you can be confident about your future and make every move count. Hello. My name is Jason Byans. I'm a former analyst and certified financial planner, and I want to help you make this complex world of retirement planning a little more simple and sensible. About 7 or 8 years ago, we were introduced to a lady named Claire through our church. Unfortunately, her husband had recently died, and she was just really worried about the future. And she actually asked us to come to her house because she had so many papers and files, boxes of files to go through. So we went to her house and, of course, just kind of sat there for a little while talking about her husband, how much she missed him, and all the things that he did. And on her dining room table were three big boxes. And so we started to go through all of these. And even though his name was Robert, even though Robert had done a really good job of attempting to put a plan in place that would make sure that Claire was in good hands, there was a lot that he missed. He made a lot of mistakes. One of the ones was he didn't really secure her income. Whenever he passed away, she lost his pension and also lost her Social Security because hers was less than his. In addition, she had a lot of their money in just one investment and was paying a lot in fees for that. So even though he really tried, he made some big mistakes. And that's what we don't want. We don't want to make these mistakes because they can really cost us dearly in retirement. So we want to jump right in and go over these four biggest mistakes that we see retirees make when it comes to retirement planning. And we want to start with income. The biggest investment mistake that I see retirees make is not being generous enough with themselves. So, what do I mean by that? Well, what I mean by that is most people would really like to have the most amount of income that they can have in retirement. And the reason that they typically don't do that is they're worried they're going to run out of money. Okay. They don't have that security. And one of the main reasons they don't have that security is they don't have a plan in place that they're confident about. And one of the best ways that you can do this is to put an income plan in place and then stress test it. We want to stress test it for market volatility. If stocks go down, we want to stress test it for if inflation goes up and all of your costs and expenses increase dramatically. We also want to stress test it for interest rates. What if interest rates get out of hand and those really affect our portfolio? So this is what we want to do is we want to put an income plan in place so that we feel security, so that we're confident about that income plan, and then we can be more generous with ourselves because that's what retirement's all about, right? You've worked your whole life saving and saving and saving, and these are supposed to be the golden years. You'll want to be able to be generous with yourself. You want to be able to go on that trip. You want to be able to bless the kids or the grandkids. You want to be able to do that hobby, whether it's boating or golf or, I don't know, gardening or whatever it may be, hunting. You want to be able to do that in freedom. And the only way you can have that freedom is if you're confident in your income plan. And once you can do that, you can be more generous with yourself. So, the second area that we're going to cover, the second biggest mistake that we see retirees make is when all of their investments are only in the stock market. Now, back in the 80s and 90s, it was very common that people would have a pretty simple portfolio. Most people referred to it as a 60-40 portfolio, maybe 60% stocks and 40% bonds, or 60% bonds and 40% stocks. It was pretty straightforward. And for many years, it worked. But what we found out in the tech bubble of 2000 and the financial crisis of 2008 and the COVID pandemic of 2020 and in the inflation crisis of 2022 is stocks and bonds began to act similarly. Okay. So what we found out was in years past, when stocks would go down, bonds would go up, or bonds may be able to kind of hold their own. Then we started to realize stocks and bonds started to act alike. Stocks and bonds started to go down. We saw this in the financial crisis, we saw this in the COVID pandemic, and we saw it again in 2022 with the inflation crisis. So, only having investments just in the stock market is one of the biggest mistakes a retiree can make. Okay, so what do I mean by investments only in the stock market? You see, if we think back into the 80s and 90s, a typical portfolio was a 60-40 split. Maybe 60% in stocks, 40% in bonds, or maybe it was 60% in bonds and 40% in stocks. And for the most part, those would work, okay? A lot of times when stocks were down, bonds were either up or they were holding their own, they were staying steady. But after the financial crisis of 2008, the COVID pandemic of 2020, and the inflation crisis of 2022, we started to realize something had dramatically changed in terms of stock market investments. What happened? Well, stocks and bonds both started going down at the same time. They started to act alike. They were correlated, is the technical term. So, your portfolio, if you were invested in a typical 60-40 split in terms of stocks and bonds, if you only had stock market investments, both of those were down at the same time. And that's really, really bad when you're trying to pull income because then you're locking in losses. All right. So, what do we want to have? We don't want to just have investments that are only in the stock market. We also want to have what's called foundation investments. All right. Foundation investments are investments where we have transferred the risk to someone else. So, an example of this may be a CD or a money market where we've transferred the risk to the bank. Maybe we're talking about insurance product where we've transferred the risk to the insurance company. Or maybe we're talking about Treasury inflation protected securities or T bills. That's where we've transferred the risk to the federal government. Because when we have investments that don't have any risk in them, when stocks and bonds are both down, we've got a place that we can go to for income. One of the best things that you can do when you're planning for retirement is get a lot of good information. So I want to encourage you to click the link below, and we would love to send you a free copy of my brother Justin's book, Designed to Last. This is a short read, only about 100 pages. And in the back of that book, there is a list of questions, the most important questions every retiree should be asking as they're approaching retirement so that you can protect you and your family's future. So click the link below, and we'd love to send you a free copy of that book. Now, let's move on to number three. The third biggest investment mistake that we see retirees make revolves around taxes. And what it has to do with is when people pull money from the wrong tax bucket. And you may be asking yourself, Jason, what is a tax bucket? Well, there's actually three tax buckets. The first tax bucket is the tax deferred bucket. This is money that you put away and you haven't paid taxes on it yet. Examples are IRAs, 401ks, 403bs, any of those typical retirement accounts. The second tax bucket is the taxable bucket. This is excess savings. You may have an account at the bank that's joint with your spouse, or maybe you have an individual brokerage account that you're just buying and selling stocks in. Well, then those types of investments, we only pay capital gains taxes on. And then the third bucket is the coveted bucket, the most coveted bucket. That's the tax-free bucket. What are some examples of that? Well, the most common one is a Roth account. Other examples are specifically structured cash value life insurance products. And we can also have muni bonds. And it just depends on which state you live in and which state you're purchasing those bonds from. But generally, those can be tax-free. So you've got tax deferred, taxable, and tax-free buckets that you can pull money from whenever you need money in retirement. And the third biggest investment mistake that we see people make is they're pulling from the wrong tax bucket. And how do we know which tax bucket we should be pulling from? Well, we need to know two things. Number one is we need to know which of our accounts fit in each of those buckets, all right? Because that's the way that the IRS looks at your money, and we want to look at your money in the same way because they're the ones that collect taxes. The second thing that we want to look at is your tax return, okay? You really can't do in-depth financial planning, really holistic retirement planning if you're not looking at the tax return. And most retirees aren't really doing that. I will be honest, most advisors aren't really doing that. But it's extremely important because what you can end up doing is if you pull from the wrong tax bucket, not only are you paying higher taxes by that distribution, you can cause other things, other types of income to be now higher taxed, like your Social Security. So it's very, very important whenever we're pulling money in retirement, we want to be making sure that we're pulling it from the right tax bucket. So, the fourth biggest investment mistake that we typically see retirees make revolves around legacy planning. And it's when people procrastinate. They put off investing the proper amount of time and money to put a plan in place to make sure things are orderly. And to be fair, I understand why people procrastinate. These aren't easy decisions, right? Making decisions about when you're incapacitated, end of life, choices that you need to make, about splitting up who gets what, about talking about all of these things revolving around death. But it's so very important. And survey after survey shows less than half of retirees have their estate documents in order. So they don't have a will in place, a living will. They don't have financial powers of attorney or healthcare powers of attorney. So when they end up being incapacitated because of some type of illness or injury, some traumatic event, the people that they need to be acting on their behalf don't have the authority to do so. The other issue is when people pass away and they procrastinated and they didn't do proper legacy planning. Then you can see a lot of fighting amongst family members. You can see things ending up in the courts, and then the judges and lawyers get to decide what happens with things. And then also, a lot of times, you end up paying unnecessary taxes and attorney's fees when a little bit of planning ahead of time could have avoided all of that. So, how do we avoid these four investment mistakes that most retirees make? Well, it's pretty simple. We need to have a plan in place. Because if you have a plan in place, you will be able to be more generous with yourself. If you have an investment plan in place, you won't only have stock market investments. If you have a plan in place, you won't choose to distribute money from the wrong tax bucket. And if you have a plan in place, you won't procrastinate and cause undue conflict with your family, possibly undue taxes and attorney's fees. You won't cause confusion after you're gone. So I hope that this helps you in terms of planning for retirement. And if you're having other questions about making mistakes, I want to invite you to click this video here where we go over the 5 regrets that retirees most often have at the end of retirement.